And we are live. Hello, everyone. Welcome to the 67th episode of Blockchain Talk. Now, in today's episode, I want to talk about RWAs, real world asset tokenization. Now, to give you an introduction, what RWAs are, quite frankly, tokenized as real world assets. It's actually the definition taken in the name. Now, what do you need to see it as? Well, a real world asset tokenization is like taking gold and tokenizing it on the blockchain. For example, by saying, look, I've got certain quantity of gold and I want to secure ownership through the blockchain. That is an example of real world asset tokenization. Um, yeah, let's head on in straight into it. I'm going to be explaining fundamentals, the current hype around it, and getting into detail into a few practical examples. What I can tell is that real world asset tokenization is not limited towards NFTs alone. It is much more inclusive within the cryptocurrency community within blockchain technology. More on that later. So there's a little article from Binance, Real World Asset Tokenization, primed to search in 2023. It's an article posted in January of this year. And well, herein they say, according to research, one of the major growth areas in 2023 will be the tokenization of real world assets. Its most recent report, published on January 4th, analytics firm Coinmetrics identified growth areas for the cryptocurrency industry in 2023. One of the growth sectors mentioned was the tokenization of real world assets. Physical and traditional financial assets are represented as digital tokens on blockchain in this process. Tokens then can be bought, sold, and traded in the same way that securities are. This is actually a very important note, traded in the same way that securities are. For those of you who follow most of my live streams, well, all of the live streams I've did to date, you will notice that in certain episodes of the Crypto Bull, which is my live stream fundamental and technical analysis series of coins, that I tend to mention or define some coins as securities, meaning that they had pre-launch, be pre-mined, that they have been used to, well, gather funds for future development, and that I say they are probably going to be considered as securities under current law. So this implies that the same thing can happen with tokenized real-world assets, all depending naturally on the changing regulatory and legislation within US borders as well as in Europe, Asia, whatever, making them probably taxable events. Everything naturally depends on how it is being done and if the funds, well, if the sale of the RWAs, the already tokenized on beforehand, is being used to leverage money for further development or to buy in more backing assets, etc. That's something which needs to be seen. Goes slightly beyond the scope of this live stream, reason that's already quite technical where it concerns laws and regulations, which are ever changing, especially here in 2023. However, let's continue. Furthermore, for those who do not or cannot hold physical assets, this creates a more secure and efficient investment environment. Indeed, this sentence is quite true. Certain assets are hard to come by, or people do not immediately know how to come by with them within their own national borders. Tokenizing them means tokenizing ownership, and through exchanges, if those tokens are being listed, allows people to get their hands on, well, gold, silver, property, art, even. So it allows them to invest in such hardware, having factual ownership without really having the need to physically hold them. Actually, there are, well, there's a plethora of different issues and problems which come with that. It needs guarantees of ownership, etc. There's the bridge from digital ownership towards real world ownership, which needs to be well handled. Not always that clear, and there certainly is room for rug pulls. However, on that probably later. Latter half of 2022, crypto bear market has seen a decrease in the tokenization of real-world assets. Nonetheless, Coinmetrics sees this as a potential growth area in the future. Is indeed true. However, this is mostly the result of tokenization in the form of NFTs taking. Come on, select. There we go. Is most likely the result of the popularity of NFTs having waned in 2022 due to the ongoing bear market. What you need to know where it concerns NFTs, whereby assets can be tokenized into an NFT, a non-fungible token. Non-fungible tokens, their value is very dependent on the native currency of the blockchain upon which they are minted. For example, if you bought, let's take a good example here, some Beeple artwork, which is available on the Ethereum blockchain, you will notice that the value of one Beeple NFT has declined dramatically. By reason, Ethereum itself has declined in value. And since an NFT is backed by the native cryptocurrency of the blockchain it is minted upon, the value of said NFT will decline even more so as a result. So what is being written here is a logical conclusion. However, this does not always apply to real-world assets tokenized onto the blockchain. We'll see why later. Despite this drop, RWA tokenization remains a promising growth area in the crypto market. Okay. It cited a recent pilot program by a number of banks to tokenize various projects in order to reduce transaction settlement times. Furthermore, in November 2022, JP Morgan, Deutsche Bank, and SBI traded tokenized currencies and sovereign bonds. For the experiment, they used the Ethereum Layer 2 scaling network, Polygon. This demonstrates the increasing adoption of RWA tokenization by major financial institutions, as well as their use of L2 layer 2 for scaling, according to the report. Layer 2s aren't always necessary for tokenizing real-world assets. More on that later. MakerDAO, pioneering DeFi, is also delving deeper into real-world assets. Maker's endgame plan proposes converting DAI into a free-floating asset that is initially collateralized by real-world assets. Furthermore, DeFi stablecoin protocol has recently invested 400 million in short-term treasuries and 100 million. Let's see if there's something else of importance here. Number of RWA-backed loans has also increased. This demonstrates growing demand for RWA tokens as a means of financing real-world assets, according to Coinmetrics. Run strategic. That's about it for Binance. So there's a few important things that we have learned here. And I made mention of not all real-world assets are tokenized as NFTs. Like I said, more on that later. Those that did get tokenized as NFTs see a drastic decline in trading, partially due to bear market from 2022 and more or less still ongoing despite the recovery of the cryptocurrency market. What else was there? Yeah, and naturally that I suspect RWA tokenization is a promising growth area in the crypto markets. Let's delve a little bit deeper into the mechanics. There we go. RWAs asset want in a superior format. Most people are not financial experts, do not care about intricacies. You guys can read what is being mentioned here. Important parts are: securities are used to raise capital and create business that provide goods and services. They are what allows society to grow and thrive. Here we are talking about real-world assets in the form of loans in the forms of investment promises whereby you can get a return. In a certain sense, it is, well, a tokenization of a real world asset. It is like holding a certain debt tokenized to a company, and it is up to the company to uphold the promise that they will pay you back and that you have a certain guarantee of returns. Simple as that. So that expands the different real world assets that can be tokenized from not merely hardware, and I'm really talking art, gold, silver, etc. It also includes financial bonds, stocks, and loans. Continue. But the financial economy is not static. Starting in the Babylonian Empire in 3000 BC with clay tablets to track debts before evolving into paper formats, finance has entered an almost purely digital era. Despite these transformations, recording of financial events still takes place across siloed ledgers that must be reconciled. This results in significant inefficiencies such as increased costs and lengthened settlement times, the lack of interoperability, and the resulting fractionalized sorry, I'm getting distracted here. Liquidity presents an opportunity for the next era of finance to be around asset tokenization. So here you see a little overview of the history of record keeping. So physical form, paper-based, electronic form, digitized. And you have tokenized form, digitized, and a single network for both transfer value and messaging. The physical form network was physical venues, then became an electronic network. Think of the service of a bank and the world government organizations keeping records everywhere. And then tokenized form is more or less the same as the electronic form. However, this time it makes use of a decentralized network, and you have an immediate transfer of value, whereby here you were still reliant on a central entity saying yes or no, or even negating some of the things. Let's talk about the advantages and disadvantages. We have here as an advantage increased efficiency, as naturally a blockchain's ledger serves as the golden source of truth, reducing friction during post-trade reconciliation. Atomic settlement also removes the need for delayed T+2 settlement, as assets can be simultaneously delivered with payment. Now, small thing of note here, they mentioned a blockchain's ledger serves as the golden source of truth. That is indeed correct up to a certain level. Now, everything, all information stored on a blockchain is naturally uncensorable, cannot be adjusted. However, that is on the condition that it is a public blockchain and whereby the network is being carried by a decentralized worldwide community with a high enough hash rate and security that no attacks can take place. If we're talking about a private blockchain, well, in that case, you will only need to convince a small amount of nodes or even master validators in order to make changes, to even reject certain information. That's one of the subtleties that needs to be mentioned. If we are talking about Bitcoin, for example, and you are going to tokenize some real world assets on it through ordinals protocol, for example, in that case, you can rest assured it is going to be safe, as it is being inscribed directly onto the Bitcoin blockchain, and the owner of that, well, is the owner. It cannot be negated, censored, or overturned. On the other hand, if we are talking about a very small blockchain and there's only 5 nodes, for example, who do all the transactions, and they have very small hash rate, another miner comes along which has the power to overpower all 5 of those nodes, well, you can rest assured that changes will occur and that certain transactions will be rejected. So with that, do watch out. So the subtlety I want to point out here is do watch out with which kind of blockchain and the structure of the possible company behind it. It's a very important note. Reduced costs. Self-executing autonomous protocols reduce the need for intermediaries at every step. Early results show an up to 90% reduction of the cost of bond issuance when using blockchain-based record keeping, and an up to 40% reduction in fundraising costs. Reason, think ICOs, community-based crowdfunding, and naturally, with blockchain, you are only limited towards transaction fees. In the real world, when you buy an asset, sometimes there are additional costs involved. What are those additional costs? Well, administration, paperwork, verification papers, for example, for art that if you buy, for example, let's take, for example, you buy the Mona Lisa, how weird and exaggerated it might sound, you will still need a certain paper which declares you have the official thing, that the official thing is the factual Mona Lisa and not some cheap copy. That implies that certain certification needs to be going on, and that's an additional cost which might be recurrent after a while. So with that, if you start tokenizing things, it isn't really necessary, by reason all information is being stored on the blockchain, which implies certain costs will fall off, and that results in, well, the spoken about 90% reduction of the cost of bond issuance. So on that, increased transparency. Public blockchains are auditable in real time, opening up the ability to verify the quality of the asset collateral and systematic risk exposure. Disputes around record keeping can also be mitigated through public dashboards showcasing on-chain activity. That's a very long-winded 2 sentences or paragraph just to say you can check the blockchain explorer. The one holding the asset in his wallet is the factual guy who owns it. An asset is not suddenly going to be moved without consent of the owner of the private keys of said wallet. My reason, everything which is being set onto the blockchain will be kept on the blockchain. Everything which is secured, saved, and inscribed on the blockchain is publicly viewable. That's the increased transparency that blockchain compromises. Well, that's the, well, offers, that was the correct word. Built-in compliance. Complex compliance rule sets can be programmed directly into tokens and applications offering services involving tokens. Privacy preserving KYC tools can be implemented to shield user privacy while remaining compliant with the relevant regulations. Has more to do with the platform whereby the things are being tokenized. It has to do with know your customer or identity verification, that it is going to be limited towards a few individuals and not to everyone else. It is, in regards to that, pseudo anonymity, but at the same time there is compliance of use depending on national borders. It's a little bit of a legal tangent. Liquid markets, tokenizing assets within private markets, e.g. pre-IPO shares or initial project offering shares. Real estate, carbon credits, increases the accessibility of historically illiquid markets, a market with trillions of dollars worth of largely inaccessible assets. Meaning if you start tokenizing, for example, that with carbon credits, you make it available to retail, towards small-time investors like myself, like yourself and other people. Currently, carbon credits are mostly being traded through governments, is being traded by banks and other big financial institutes, and retail really has no say about it. Now, those are multi-trillion markets where money can be made and which, on certain conditions, can impact the economy. Tokenizing carbon credits, for example, allows retail to step in to make a profit and to help, in a certain sense, that ecosystem to access $1 trillion market. So it provides additional liquidity, that it isn't reliant on governments only. it quite literally can suck out some additional money from retail. Innovation with assets and application logic existing within a common settlement layer rather than in disconnected environments. Entirely new financial products can be created, from fractionalized real estate funds to liquid revenue sharing agreements. Tokenization increases the ability to build products that were previously infeasible, meaning you can get quite creative. You can tokenize, for example, your piggy bank that you have had since childhood and say, look, I'm going to tokenize it. I'm making the promise, doing all the necessary steps here, that the one who holds my NFT is also the owner of the piggy bank I have at home. That's the kind of innovation or creativity that is being talked about. Naturally, no one is going to say, oh, here's my little piggy bank from when I was a small child. I've tokenized it as an NFT. Naturally, those things are too small. It's a bit of a brain fart to do so. It's creative, but it goes to show what can be achieved, and that's the kind of innovation it brings. Our RWAs are tokenized and the challenges involved. Yeah, this is getting interesting. This is what I talked about earlier when I said RWAs, or real world assets tokenized, do not necessarily refer to NFTs. Here's why. First format is non-native tokens, where on-chain tokens are issued to represent RWAs that exist and are managed off-chain by custodian. The most common type due to the infancy of RWAs and the ability to leverage existing financial infrastructure around asset custody. All existing USD collateralized stablecoins have adopted this token format. They are referring here towards stablecoins, and everyone who thinks about stablecoins automatically thinks about BUSD, about Tether. Even some talk about Terra Luna USD, the one that got depegged in 2022. Tremendous crash of the entire market. But anyway, that goes to show that you can create a blockchain and tokenize real world assets, in their case, in the case of traditional stablecoins, imitating the value of the US dollar, the real world asset being real world dollars being backing the stablecoin. US dollars in that case are the asset itself. Now, naturally, with Tether and BUSD, it's going to be a mix of both cryptocurrency, fiat USD, and a variety of bonds and stocks being held in custody by banks and other institutes, linked towards the blockchain with audit reports, etc. And at that point, you have tokenized a real world digital asset. I've got two of them prepared, it's going to be three prepared of these as examples. Second format is native tokens, where on-chain token is issued and serves as the RWA itself, meaning it does not represent any type of off-chain asset. For example, bonds that are directly issued on-chain as tokens are native RWAs, while a bond that is issued and held off-chain could be tokenized as non-native RWA, meaning governance coins, or even loans, or even, and that's a small distinction that needs to be made, some NFTs, that includes NFTs like the Beeple, for example, that isn't really a real world asset, but for example, if it was printed out and it was real art, and then ownership was minted onto the blockchain, we would be talking about native tokens, native non-fungible tokens being created on Ethereum or even on a separate other blockchain. It's important to note that RWAs can be issued on either private or public blockchains, private chains, yada yada yada. That we already know, I explained earlier. There's a few challenges that need to be considered. This is the biggest one: regulatory clarity. Laws indicating if the trade of such tokenized assets are taxable event, yes or no. The companies behind them, are they indulgent into fraud? Are they auditing, etc., etc.? So some regulatory clarity. Permissions is a direct result of it. Generally, in this instance, they mostly refer to KYC, or know your customer base. So identifying ownership, same comes here. Connectivity, multi-chain ecosystem continues to expand, resulting in a growing collection of chains that institutions must plug into, access, and issue their real-world assets. Solutions such as the forthcoming cross-chain interoperability protocol enable institutions to not only connect existing backend system to blockchain, but also bridge RWA's cross-chain. So meaning that if you have tokenized an asset on, for example, the Ethereum blockchain, make use of the Ethereum network, well, you will be limited to the Ethereum network, and you can transfer ownership towards someone who makes use of the Binance network. With connectivity, we are talking about a multi-chain ecosystem, meaning that you can make a bridge from, well, you can bridge the asset on Ethereum towards Binance. It is something for the future, and we are really talking about Web3 here. This is mostly limited towards stablecoins, and we are talking about proof of reserves, meaning if you are going to tokenize a real world asset such as gold, silver, or even created a stable coin imitating the value of the US dollar, well, you will need to prove that you hold these assets in real life, and thus comes the need for proof of reserves. Head on over to a few important coins. For example, we have here Paxos Gold. Now, this is a stable coin whereby its value tries to imitate 1 troy ounce of gold. I believe it is, yeah, it's written here. First example is backed by 1 fine troy ounce of gold stored in LBMA vaults in London. If you own Pax G, you own the underlying physical gold held in custody by Paxos Trust Company. Referring back to the previous one, it implies it is, if I'm not mistaken. You can see I'm not very well prepared and that I'm doing these things on the fly. This one here, non-native token. Where on-chain tokens are issued to represent RWAs that exist and are managed off-chain by a custodian. Specs Gold is an example. Now this is, well, it has its very own blockchain, I believe, and well, they need proof of reserves to show, okay, for the amount of tokens issued, we have the necessary amount of gold or gold derivatives within our very own banks with a custodian, do audit reports, etc. They got a little white paper. I'd say read on through it. It explains a little bit about modern day gold market, how it is designed, how it functions, etc. Another example, and this one I want to highlight, is Silver Token. It is the same setup more or less like Pax Gold. However, as you guys can see, he's doing pretty nicely here, but this time it is being backed by silver. It is another precious metal. This is considered to be a stable coin. Now, why am I mentioning Pax Gold and Silver Token? Well, for that, I need to be honest, and I'm not much of a fan where it concerns stablecoins. But to be more exact, I'm not a fan of stablecoins imitating the value of fiat money. And I've had plenty of discussions with people whereby I said, yeah, but you need to invest in stablecoins backed by physical gold whose value tries to imitate physical gold or that of another precious metal. And Silver token does this with silver, Pax Gold does this with gold, and there are existing other stable coins whose value is derived from other precious metals. Mostly gold. Silver is a little bit unique. It's slightly rarer to see. And well, can earn monthly returns, 24-hour buyback, so that's for trading. That's not really my thing. Do you have no account required, decentralized ownership, free storage? They keep it in custody for you, stable safe haven, and stable coins in this sense, being backed by precious metals, are actually the better choice. It allows you to enter the markets for precious metal and allows you to invest in gold, silver, palladium, whatever, without having physical ownership. Sure, it relies a certain amount of trust. Trust that the company behind Silver Token or the company behind Pax Gold or even Tether Gold, that's another example of a gold-backed stablecoin, that they do have the silver in reserve, in custody. For that, they will be needing audit reports. And tokens like these are naturally RWA's real-world assets tokenized onto the blockchain. And they give a plethora of advantages, mainly all the advantages of owning real physical gold together with all the advantages blockchain brings them together. And you see plenty of arguments within the Bitcoin community and in the crypto community whereby people say, yeah, but gold, it's a multi-trillion market, and you see Bitcoin is only there, it's at 0.5 trillion, whereas the gold market is at, I believe it was 11 or 12 trillion market. So we still have a lot of growth to go, yada, 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 yada. This, what you're seeing here, is an actual bridge. This is an actual bridge towards the gold market. This is an actual bridge towards the silver market. That's one of the reasons that while I do not immediately endorse stablecoins and that imitate the value of fiat money, I'm going to be correct here, I do stand behind things like silver token, Pax Gold, or even Tether Gold by reason that their value is derived from a backing of real physical gold. It allows you to own gold without physically having it. Naturally, with the naysayers, I will agree you do not hold it physically, so you can put question marks around real-time physical ownership. However, it bridges the market. And even if you do not hold it physically, some of these, and I believe Silver Token does this, and in any case, Pax Gold does it as well, you can still trade those tokens for the real stuff. So that account, it's something very nice to see. Another example, and this one I've mentioned plenty of times in all of my Twitter tweets, even in my courses on cryptocurrency and Bitcoin. This is called Propi, and this is tokenized real estate. Why am I highlighting this? Well, back in 2020, or was it 2021? They were the very first company who tokenized. I forgot the word in English. Sorry, guys. They were the. I wanted to say retail. No. Property. They were the very first to tokenize property. If I'm not mistaken, they were the very first people to sell a house. No, it was an apartment. It's a tokenized form, all in a legal setting. The owner of the NFT did buy the house. And as you guys can see, they expanded in the meantime. These are naturally very big villas and mansions. You can see here 8,250,000 for this one. So with Propi, if you buy it, you can have it in tokenized form. Research back inventions. So this goes to show, I'm really showing you this, guys, just to show that plenty of possibilities exist within the cryptocurrency market. That with a bit of creativity, you can start tokenizing value makers and assets, that you can get involved without real physical ownership. You will have digital ownership, but that means you are just one small step away of real time ownership. Some would say this is something that stands at the base of the metaverse. And for those of you who follow me, when I talk about metaverse, I've always talked about simulation, but also about doing things in the metaverse which can have real life effects. Like, for example, one of the most commonly used examples that I use is that if you go into a metaverse world, like say Decentraland, and you go up to a certain stall where they sell pizza NFTs, and you choose a pizza NFT, you buy it with some of the local currency from Decentraland, and within half an hour you have a real world pizza at your door. That's the kind of things we are talking about. In this case, I've been mostly talking about gold, silver, and property. These three examples I'm merely showing you on screen to show you it's already possible. They might seem very innovative right now, but trust me, within a few years' time, these might become the basis. To stop sharing my screen. There we go. With that, I've done my little rant about real world asset tokenization. I hope you guys learned something new. If you guys have questions, naturally, you can subscribe to my channel, leave a comment down below underneath this video, or even reach out to me on social media. With that, I'm going to say thank you guys for watching, and up until next time. Bye.